Welcome to the Investor Financing Podcast, where we interview real estate investors and lenders so you can learn all the secrets to getting your projects funded and scale your portfolio. Learn about fix and flip loans, BRRRR financing, rental, fix to rent, commercial, multifamily bridge loans, business loans, and so much more. And now, your host, Beau Eckstein.
We get a lot of people that that always talk about the positives, right? But we know if you've done any amount of deals that there's always negatives, and I think the value you bring is that you're going to tell people how it is, and the trials and tribulations that go along with it. But if you could kind of walk us back, I don't know, prior to you becoming the trademark apartment guy. That's copywritten or trademarked, I'm not sure, but
yeah, it is.
Yeah. So prior to that, so you got started in your multifamily journey in 2014. Is that accurate?
No, well, I started my education in 2011 and actually bought my first deal in 2012.
Okay. Wow. So but prior to that, what can you kind of walk us back prior to that? Like, what did you do for a living and what did that look like?
So, my famous story, right? I'm a college dropout, barely got out of high school, came from two parents that dropped out of high school themselves, grew up poor, didn't thrive in an academic world. So I dropped out, and then that kind of led me into retail since I didn't have any training, really, any schooling. I did that for 18 to 20 years and just hit a wall, had to walk away and find something else to do with my life. I was a Dave Ramsey kind of disciple dude. So I was living way below my means, not, paying cash for my house and my car and all that stuff. And I thought there's a better life than working retail and doing this. So I quit and I found a mentor that taught me how to invest in real estate. And then within real estate, how to do syndications in multifamily. So again, I started with that person in 2011. And then bought my first deal in 2012 and have syndicated over 1,100 units so far. Have two management companies, actually, a construction company, an asset management company. And now we have online education that we've kicked off, written the book. So, I'm just trying to get my fingers into any and everything because it's a blast. And the more of this stuff that I do, the more people I can help. So I'm really having a good time.
That's awesome. So can you kind of walk me through this process? So as you syndicated your first deal and on that first deal, did you outsource management at that point before you had a management company? Obviously everything was outsourced. And then as you kind of progressed, you realized that the management companies weren't performing to your expectations. And then you formed your own management company. And then instead of paying outside third parties to fix the properties, you just said, let's bring it in-house and create our own construction company. Is that kind of the evolution so far of how it happened?
In a way. So my first deal, I have no experience. I have no job. I have nothing, right? So the banks spooked. They're willing to take a chance on me. But they said, look, you're going to have to hire a third party, somebody that's professional at this. I'm like, okay, fine. But they didn't put in my loan docs that I had to have them for any specified amount of time. So I closed on the property, had the management company working for me. And 6 months in, I hired my own manager and I let them go. And that was the beginning of my management company right there. 48 units. So I had a part-time manager and I had a part-time maintenance guy. And it just kind of grew from there. It's been profitable from day one. I've heard people say, well, you can't have a profitable management company until you get to 300 to 500 units. That's not true. It's not true at all. Some people that you and I both know, I've heard say that. And the way they would start one, possibly. But if you bootstrap it and you wear every hat yourself and don't expect to hire people to fill those roles, holy shit, you're profitable from day one. So it's given me more control. And I just love owning companies and working with employees. So it's been great that way. But then the construction thing, that happened. I'm an entrepreneur. I'm looking for problems that I can fix. And the problem to be fixed was my problem. I did not like working with GCs. There are some really good ones, but most of them are horrible. They don't communicate. They're not professional. They miss deadlines. They miss budget. They miss everything. And I was like, I'm so frustrated, irritated, and pissed off. So I thought, you know what? We office out of the house, my wife and I. She's the CFO of the companies. I'm the CEO. I'm down the hall in my office. She's in her office with one of our employees. And I come running down the hallway. I said, we're starting a construction company. And she's like, son of a bitch. Like, yep, sorry. We just got to do it. So we did it. And it's made our lives a lot easier that I don't have. I'm GCing my own projects now is what it is.
That's awesome. So you really, did you have a construction experience or really is it just kind of getting the right project manager GC type person that's not a GC underneath your umbrella of companies that kind of runs it now? Or, I mean, before you got into real estate, did you have any construction experience?
I helped build a house in 10th grade,
Okay.
right? There was a class called Building Construction Trades in high school that I took, but no, I had no experience at all. But I thought, you know what? I can GC because I kind of sort of GC anyways, because I'm chasing down the damn GC all the time, and we would GC our own little bitty jobs. Like if I got the pool replastered, I would be the quote unquote GC for that. So, I thought, well, I could just go out and we don't have our own crews at all, right? I'm a general contractor, but I'm basically overseeing the project. I work as the project manager, basically. I have my corporate staff will handle procurement, getting all the logistics set up, but then I'm walking to develop the scope of work with the different contractors. I'm walking their work and I'm doing the final sign off. So it works really well for us. Our regional managers will sometimes be involved in walking expectations. It's not as hard as a lot of people think it is because, again, I don't have paint crews and drywall crews and carpenters. I still outsource all that and sub everything out. I'm just the quarterback running the whole thing.
I think that's important too, because if you're raising money, right, you got to make sure shit gets done properly and on time. And I know from my flipping experience that's always been, it's kind of, you can find the deals, but actually getting them turned around, right, and getting them to the finish line where you can either sell them or put tenants in is always the challenge. So I'm pretty laid back, but I've realized that I've had, in our business to renovate and to manage construction, you have to be on top of it. You have to be on top of these people or it's not going to get done.
Exactly. And, it, like I said, it gives me control, but another side benefit of it, when I'm hiring an actual GC outside of our company, I'm going to pay them anywhere from 15, well, probably usually 20 to 30% overhead, right? So what I've done is I've cut that dramatically. I'm still going to get paid for doing the job that a GC would have been paid to do, but I'm doing it for a lot less. So I'm saving the partnership money and I have better control over it. I actually had a GC on one project before I did my own. It was supposed to be a month and a half. It was 4 months later, and we're finally doing the final walkthrough. And I said, okay, look, now that we're done, we're walking, everything's okay, but I have a question for you. He goes, yeah, well, what's that? I said, you missed your deadline by 2.5 months. So one of two things happened. You lied to me or you're completely incompetent. Which is it? So I painted him into a corner. There's no good answer. He said, I lied to you. I was like, what the hell? I almost said a really bad word there. It's like, what the hell, dude? He goes, well, look, if I didn't lie to you, I would have never gotten your job because everybody else out there is lying to you on timeline as well. I'm like, I'm done with you. I said, I'll never use you again. I appreciate the honesty. Have a wonderful life. And that's what got the gears grinding going. I'm not going to be lied to again. Now, I'll be lied to sometimes by a sub, but I don't want the guy running my entire project to be lying to me. It pissed me off, and I fixed it.
So going back to your first deal, the 48 units, it was probably 2011, 48 units. I don't know. It was a $1.5 million purchase. What was it? 2 million?
It was $1,625,000 for
okay,
48 units. So we paid $34,000 a door in Austin.
Okay. So that same property is worth what would you say?
Well, I paid $34 a door for it. Now, the last time it traded was probably about $85,000 a door. So it probably traded for over $4 million. We sold and got almost 2.7 on it, we made a killing. I tripled my investors' money just from the sale profit, not the cash flow, just the sale. We tripled investors' money. So yeah, we left some meat on the bone or whatever you want to call it. We left some profit, but it was important for me to lock in a profit that I wasn't going to take a chance of, cap rates rising and value eroding. So I thought, I'm not going to be greedy. I got you guys a triple. Let's sell. And that one deal turned to 2 other deals for me. So investing in that one created 3 total projects for me. So it worked out beautifully.
That's awesome. Now in the market we're in now, obviously COVID, we know. I mean, are you still actively buying right now, or are you kind of just waiting? Are you kind of you would buy, but you're not buying unless it's a great deal? I mean,
so what I've been telling people for about the last 2 or 3 months is that, look, I have no idea how to underwrite anything anymore because I don't know who's ever going to pay rent again. Hopefully it won't be as bad as it could be, but I just don't know. So I was operating kind of blind like everybody else. So I thought, let's just hold out for a little while. About 2 weeks ago, we finally decided, we're doing pretty okay. There's still some crap we got to get through before we're on the other side of this, but we have started looking again. Cap rates have just collapsed. Values have skyrocketed. So finding the right deal, especially with all the lender imposed reserves and escrow requirements now, it's not easy to find a deal that pencils anymore, but we're out there actively looking.
That's true. I mean, the rates are super low, but still, it's difficult when you have to bring in 9 or 12 months reserves, right, on top of everything else.
Exactly. And if you're dealing with less than a $7 million loan for Fannie, you got to bring in 18 months.
So your typical strategy on these buys, these acquisitions, is typically a 3 to 5 year hold. You don't typically plan to hold longer?
Well, yeah. So the documents will always say it's an expected 4 to 7 year hold period. Yeah, I can't hold them for very long past that because the investor needs to turn their money over, right? So I would like to own these things for the next 40 years. But again, that doesn't help the investor trying to compound their money, and the velocity of money needs to kick in for them. So our plan is 4 to 7 years. We haven't made it to 7 years on anything so far. Everything we've sold within about 3 to maybe 4 years. But the expectation going in is 4 to 7.
So your syndication model, you could design these syndications where you hypothetically, if you execute like a value add play and create forced appreciation in this building. I know some people would strategically refinance and cash out their investors and then could potentially hold the property. But for you, I mean, the value in most syndicators I see is that, your first and foremost job is protect the investor's capital, right? And to earn a return for them. I mean, that's what you do first and foremost, right? As a syndicator. But yeah, I'm guessing, and it seems like these short-term bursts for syndicators, like you make all your money quickly, but I'm wondering, long-term play, right? Like for reoccurring cash flows, like if you're always constantly buying, I mean, when do you buy and hold for 30 years or you're making such a great profit in a short amount of time, you just keep that model going? But I'm just curious on your mindset there.
Well, it sounds like I'm hearing what you're saying, and what I think you're making some assumptions that don't hold true with me. One of our really good, close, personal, like mutual friends, he does a lot of deals, and like most syndicators, they live a lot on the acquisition fee, right? So I'm going to keep doing. I don't charge an acquisition fee. There is no acquisition fee for me. There's no disposition fee or sale fee. There's no refinance fee for me. Everything for me is cash flow. So I don't offer preferred return, but for that, I also don't charge them all these fees, right? So I'm not going to hit my investors with a $400,000 to $800,000 fee on the front end when I buy a property, because I haven't done anything. And there's nothing wrong with that model. Don't get me wrong. That's a great model. That's what almost everybody does. I just don't like the thought of this big sunk cost expense to the partnership, day one of operations. I could run this thing into the ground, lose everybody's money, but hey, got my 400, I'm gone. I don't like that. So I don't offer a pref. So my cash flow is pretty high always because the deals are more important for me to have the cash flow because I live on cash flow. I don't live on my balance sheet or my net worth. I don't give two shits about my net worth. It'll just take care of itself. I want cash flow and I want steady cash flow. If I get these $400,000 to $800,000 infusions of cash, hey, that's great. But then I got to go work to find the next deal. And that might make me make a bad decision to get a deal just so I can get another acquisition fee. And there's a hellacious tax burden that comes with that too. And I just don't want to deal with any of that crap.
So typically when you exit out of these properties, you don't normally 1031 exchange. You sell them and the investors take their proceeds. And then hopefully you've done a great job and they'll reinvest in your next syndication because they've got a good return and they like you.
Well, we've done a 1031 before and, it worked well. We got about 50% of the people in 120 unit to agree to let their money ride. We cashed about half of them out. Half of them went forward with us and we took a 120 unit property with the profit and then we turned it into a 200 unit property. So we have done a 1031. It's not the easiest thing to pull off, but it's totally doable. But yeah, normally we'll just sell. Everybody will take their cash and then a lot of them will just run into the next deal and just pay their taxes.
So fast forward to today, you now have a little bit different buying appetite. You buy basically 180 to 250 units. Is that kind of your sweet spot? Like
200 to 300. Yeah. I mean, we'll go down to 100 to 150 if it's the right deal. But the bigger these things are, the easier they are for me to run as a management company. The more, consistent your profitability is, the more kind of rational everything is. So we definitely like to play in the 200 to 300 unit range now.
Now, is your book on Audible yet?
Yes, it is.
Okay, good. I was waiting for it to become on Audible because when I'm at the gym, when I do my cardio, when I'm lifting weights, I listen to heavy metal or rap music.
Yep.
But when I'm doing the cardio, that's when I listen to my podcast and my book.
Yeah, so don't judge me based on the narration. I was talked out of doing my own book narration. So this guy, I mean, I'm sure he's classically trained and he's done like Shakespeare and shit. I don't know, but dude, it was not me. Then next thing we did, we went to the bank and we were like, Ma, what the hell is this shit? That's not what I heard in the audition. I'm not real happy with the voice. He was very professional, but he doesn't have my energy or anyways, it's out on audiobook. The content is good. I'm just not crazy about the narration.
So when you did your first deal and it sounded like you didn't have much per se going on, financially at that time back in 2010. And you had enough, you knew you needed a mentor, you found a mentor, kind of learned a little bit from him or a lot from him. And then you took action and her, see?
Yep. As a woman, dude, she was a badass too. I love working with women. They have such a better brain than we do on so many things.
Shame on me just assuming it was a guy. Sorry, ladies, if you're listening, I didn't mean that. But so when you found this deal, were you obviously you're nervous kind of going from like not doing fix and flip single family homes, not having a rental portfolio at all. Now you're taking on a 48 unit building. You probably are, really haven't got your deal analyzer calculator going yet where you can really underwrite these deals. You're probably still handwriting and penciling it out and just double checking, but you overcame your fear, right? And then you tied it up. And at that time, did you have investors you had a few maybe that you thought about? How did you go about raising money on the first deal? Was it more of a joint venture?
So a couple of things. So first thing is, yeah, dude, I was scared to death. I got all the learning and reading all the books and listening to all the stuff and talking to my mentor. But the day before I called her, I said, hey, she goes, what? I don't know what the hell I'm doing. She goes, it's okay. I do. I'm like, oh, yeah, that's right. I'm working with you. She goes, if you'll just continue to listen to me like you have, I'll make sure this goes smoothly for you. So yeah, I was scared. I'm very confident. I'm a crazy confident person. Like most people listening, I've been successful at everything I've tried, but this scared the hell out of me, right? Because I got, $600,000 of other people's money on my shoulders. But yeah, so we got into it. Everything went well, as a first time deal would go. We had some stumbles, but we managed through it. But my first investors, I started a meetup in 2011, and it was me and another guy, and we would meet at Starbucks every other Wednesday to talk about real estate and what we had learned the previous 2 weeks, because we were both trying to figure it out at the same time. And every time we'd go to a RIA, or we'd go to another meetup, or we'd go to an event, we would always spread the word that, hey, we're meeting at Starbucks if you want to join us. Grew to about 300 or 400 people. But my first deal, all but 2 of those investors came out of that meetup, because we got to spend 6 to 12 months with each other, get to know each other very, very personally, very intimately almost. And they trusted me. They liked me. They knew you've got no experience, but we like your character, and we know you're working with a very qualified mentor. So we trust you enough to give you our money. So I had people give me as much as $100,000. I had 2 of them sign on my loan. I have no experience. I have no job. I'm a college dropout. I barely got out of high school. I worked in retail, but it's a connection thing, right? It's the whole thing. Everybody talks about this, right? It's all about networking and, relationships. And it really is.
You're listening to the Investor Financing Podcast. We'll be right back after this break. Are you looking for funding? Are you getting frustrated trying to find a lender? Visit investorfinancingpodcast.com and click the Get Funding button. Complete the simple form and schedule a free phone consultation with one of our placement specialists. We have a proprietary directory of funding partners that can help you get the funding you need. It's fast and easy to explore the options available for your specific needs. Don't wait. Visit investorfinancingpodcast.com and get connected.
They had faith in my ability to execute, so they gave me their money.
I love that story, because I think when I first met you, I had like a different, I was expecting a different person, because your appearance and like your Facebook or whatever I saw was like, you're very like kind of a stiff person. Like, I wouldn't expect you to have the personality you do, which is good, because I relate to people like you versus like a CPA type of person that's gonna, and I think people have to know, like, and trust you to do business with you. I mean, there's different personality types, but I could see that I was very, I would have judged you one way, but you're a complete opposite character than I would have thought if I was just looking at you on paper, right? And then I get your whole story, and I can relate to your story. And I like the fact that initially in this beginning of our conversation, where you were talking about, hey, you guys can do it too. You don't have to go buy a 100-unit building. Go cut your teeth on a 20 or 30-unit building, but know that you're going to be doing a little bit more work on that property yourself to cut costs. And I like that, because I think looking at it from, most people want to own and control multifamily, right? Single family is just simple, right? For most people, we just think about it's an easy, but multifamily, when we start going 30 doors, I got to bring in, more money and raise capital. It scares people. But I like the fact that that in your methodology, I guess you would say, is that it's okay to buy a 40 unit or a 30 unit if it makes sense, right? Don't, just because you can't have on-site management. I mean, you're going to naturally progress, but you got to cut your teeth somewhere. I guess that's kind of, and now can you kind of walk me through that process? And then as far as your educational piece, how do you go about teaching people, how to get started really? Like, I mean, how to dive in and really feel comfortable, buying that first 48 unit building?
All right. So a lot of things here, right? So the first thing we're going to hit on is what you talked about first. And that's about, I'm who I am. And look, I drink bourbon. I like to drink bourbon. I cuss, right? And that's why, that's my book, right? Syndicating is a bitch. I've had people over the years say, man, you should tone that stuff. No, I'm not going to tone that stuff down. This is who I am as a human. I'm a good person with a huge heart that wants to help all kinds of people. But this is who I am. And I tell people up front, I might not be for you, and that's totally okay. Yeah, if you're put off by the fact that I cuss, I get it. And I'm not going to change, because that's just who I am. I'm not going to cuss at you, but I just cuss in my normal language. So I don't want to hide, because once we get into a deal together and then you realize, oh, you cuss all the time and you drink bourbon, let's figure out real quick up front that you don't like me, and let's move on, right? So that's what it is there. But as far as the size of the deal, and again, I get this question all the time. Well, where should I start? Start wherever you can, but get started. And if that means you have to start at a 5-unit, which is the smallest size to be considered multifamily, get started there. Yeah, you're going to have to turn your own wrenches, maybe. You're definitely going to have to do all of your own leasing, all of your own evicting, all that stuff, but get started somewhere. If you can start at a 40 or better, like I did, you can afford staff, and it's probably a little easier, but there's a lot of value to starting with a 6 to 12 unit, learning the ropes yourself. So now you know what to hold people accountable for, right? So just get started. Get started as big as you can safely. Don't overextend yourself. But yeah, just get yourself started. And then what was the third part of that question? I don't remember either.
Yeah. So let's roll into how you're taking on, if you're coaching people, right?
That was your question. I'm sorry.
Yeah. So I remembered.
So yeah, okay. So you asked about coaching and how. Look, I coach people, but I only want to coach people that are coachable, that will listen, but honestly, that will take action. I've taken $20,000 from somebody and they wouldn't do anything with the stuff I taught them, and it's frustrating. They get pissed off at me. It's like, I gave you everything you need. You can't get out of your own head. You can't get out of being scared. I'm sorry. I did what you wanted me to do. And because you won't do anything with it, that's not my fault. I'm sorry. So, the way I talk, the way, I'll have a bourbon, I'll go have a drink with you. I'm going to be honest with you. As I'm coaching you, I want the best for you. And sometimes that means I got to get in your ass. I got to tell you, you're being an idiot. One of my best friends, I had a happy hour with him and 2 of his friends the other day, a few months ago. His friend, we were getting up from this bar, we're going to the next bar. His friends go to the restroom. I said, hey, come here, man. He's like, what? What the hell's wrong with you? You've been talking about this and talking about that. And you're going to do this and you're going to do that. You're not doing anything. What is wrong? What's the block? So I got it. He was pissed at me for calling him out. But later that evening, he came to me and said, man, thank you so much. I really, really, really needed that. I want to talk to you tomorrow. So I'm going to give you tough love, because if I think you're undermining yourself, if there's, personal development, that kind of thing, no negative self-talk here. No, oh, woe is me, I can't do it because, no, bullshit. Okay, I'm a white guy in America. I get it. I won the lottery. I'll own up to that all day. But at the same time, I came from a poor background, no education. Like I said, poor retail guy. I did it. I've taught math teachers how to do this. So, I do a lot of coaching and mentoring. But again, if you don't have a thick skin and if you aren't confident in who you are, I might not be a good fit for you, honestly, because I'm just going to be real with you, because I want the best for you.
I love it. Now your model. I mean, you're a localized investor, meaning you're only buying stuff within an hour or 2 hours from Austin. I mean, if not closer.
Yeah, I buy in Austin and San Antonio. We just opened a management company in Nashville last year. So as we're getting our foot, kind of established in that market, COVID blows up and kicks us in the ass. But yeah, so we're looking to start branching out throughout the Southeast. But right now we're all Austin and San Antonio. It's
interesting that you're picking places where they like to drink bourbon, right?
Good point. Yes, I like to go where they like to drink.
I just went to Nashville for my first time it was a bachelor party, and my friend was he's a firefighter, and so it was 25 of his meathead firefighter buddies and me, and I'm kind of a meathead too. So, but it was an amazing time. I tell you, those guys could party. But Nashville is a wonderful, wonderful place. I love Nashville. I love Austin too. I've only been to Austin twice, but Austin is amazing too. I mean, I could easily live in Austin. I actually recently moved from San Francisco Bay Area. I now live in Las Vegas, or actually Henderson.
Oh yeah.
So I had to escape. We're getting a lot of Californians are evacuating, and they're coming to Texas, and they're coming here to Nevada and Arizona. So
Yeah, so you're dealing with people like you that we were dealing with when you moved to where we are.
Right. Yeah.
Yeah, lots of Californians, and I love Californians, but please don't try to make Texas another California because you came here and that's what you're used to. Enjoy what we have here. We're a very business-friendly state, a very dynamic economy. I've been in Austin since 1989, so I've seen a lot of crap, and I still love my town. I love everything about it. It's very progressive, very dynamic. It has a great energy and vibe. I couldn't have picked a better place to live.
So going back to Nashville, you opened a management company. So do you also manage now for assets you don't own then too?
We kicked that idea around for a little while, but I don't relish the thought of having to fire an owner, because not everybody gets it. I had a guy at a meetup one time. I was speaking at this thing. I got off the stage and he comes up to me, "Hey, Bruce, I love your story. I love your approach, but you can make a lot of money being a slumlord." I'm like, "What's wrong with you? Why would you treat people like shit on purpose? That's what you just told me. Oh, well, I would never do it, but you like, just walk away from me, please, before this does not end well for either of us." And I'm like, oh my God. So I'm thinking, there are bad people in the world, and I don't want to hire the wrong person and realize, oh, you're a bad person after all. So we decided not to go down that route. We only manage our own stuff for multifamily. Now, in Nashville, we manage other people's stuff in true commercial. So we have office, we have industrial, warehouse space, we have some retail, and we have a lot of short-term rentals, which, we got our asses handed to us during COVID with short-term rentals, but they're coming back. So we third party those assets. We don't third party multifamily at this point.
So on the short-term rental, that's interesting. So I own a bunch of houses in Indiana, and I was like looking to, and it's challenging because I'm like, I buy them right by Notre Dame College, so they would be great short-term rentals. But so your company actually handles the management of those short-term rentals, because it's so hard to find a company that you like, as somebody that doesn't want to get involved and would, hey, I'll give you 20% of the profits or whatever. I mean, how do you structure those in that business model? That seems
well, it's not even about the profits; it's top line. So it's 20 to 25%. Usually, the sweet spot is 22 to 23% of the collected revenue. It runs through these different platforms. Usually, it's going to be Airbnb. But yeah, so we charge that, and we handle everything. You just get a check in the mail. We handle all the cleaning. We handle all the communication, the arrival of the guests. We handle everything. If there's something that gets damaged, we take care of it up to a certain level. Over that certain level, we have to get the owner involved and let them know. And if we have to replace something that's within the range of not having to let them know, it just gets deducted from their payment that we send them at the end of each month. We give them a complete accounting of what it was, what we did, what we replaced, and why we replaced it. So yeah, it's about 22 to 23% that we charge, and that's industry norm.
Are you gonna, after this coronavirus, COVID-19, and you guys took a hit, now it's kind of coming back, is this something that you'll keep running as a management company? Do you like managing this asset class? I mean, is it working for you?
I absolutely love it. It's more intense. It's more like the hospitality industry or hotels, because you've got a lot of turnover. So there's a lot of moving parts. But yeah, I love it. It's profitable, actually. It's very profitable, but it can be very cyclical. And we learned with COVID, it all got shut down. Now, one thing we did do too, which was a mistake, but as an entrepreneur, you try stuff, and some things work, some things don't. You try to limit your downside. We started doing arbitrage. Right. So basically, we would go to an owner that has a building, and they say, look, I have my house and I want to rent it to you. We'll sign a 3-year contract, and then we will mark it up and put it into the short-term rental pool, and we'll take a spread. Well, that's fine until COVID hits and everything stops everywhere. So we had to exercise our out clause. But that out clause was, I have to pay you 3 months rent to get out. These are $5,000 rental payments These are really high end, very nice parts of Nashville, very new builds. So we took it in the ass, right? So we got our toes in the market, very small. We only did 3 of them for proof of concept, and it was working really well until it all fell apart. So then we ended up eating $45,000 to get out of these contracts. But it was either that or we're just going to go under. So it was painful. It was profitable while it lasted, but it did kind of blow up on us.
So when COVID starts to kind of find itself a cure, or we're in a better position, would that be something you would do again? I mean, or are you now just like frustrated with the fact that this happened? And
well, I would do it again, but we learned some valuable lessons, because I think the industry standard was, long-term leases with 3 months buyout. So we would never do that again. Say, look, I'll give you a 1-month lease and I want a 30-day out, maybe a 60-day out, but probably not even that. But yeah, like I said, the money is good while it's good, but I have to have more outs and more contingency plans in case, this was the weirdest thing that any of us have ever seen in our entire lives. So there's no way we could have projected this, or, predicted this. But now that we've seen that it can happen, well, now we know a worst case scenario, and I know how to better plan for it going ahead. Thank God we carry lots of reserves and lots of operating capital and all that. So we were fine, but it's still painful to write almost a $50,000 check.
what did he say? Yeah, Bruce P. I'm a Bruce P. fan. I can't see who it is because they didn't opt into StreamYard, but somebody's a big fan.
It's probably the bourbon.
Oh, hey guys, here's on the screen. Here's where you go to get the book. It's Bruce's website, and I'm gonna go to Audible to get mine because I'm gonna get the Audible version for sure. But guys who like the book, so they can highlight it and keep it bedside while you're drinking your bourbon. Here's the website. Here's Bruce's website, and I must say you do have some very good pictures on your website.
Yeah, we paid a lot of money for that because I don't know how to do any of it. I was about to take the time to learn it. I got more valuable stuff to do with my time. So, but no, we have a great media company that's helped us with all that. We just create, I don't know if you know what Kajabi is or Udemy, right? So we built our own Udemy, right? So we have the ability to host other people's classes. So we paid this great company. They built all this stuff out for us. So there's links on the website to our Streetversity website that you can see some of the cool stuff they've built for us.
It was Chris Jackson. He's a fan.
Hey, Chris, what's up?
You gotta opt into StreamYard so we can see your picture when it pops up. So if you opt in, then we can see your face. But
love Chris Jackson. That is a smart son of a bitch.
Yes, I follow him too. He is really smart. I got to get him on here too and listen to him.
He's a good guy.
Yeah, there's a lot of smart people, and what you're kind of no offense, but most of the people I've been interviewing a lot of multifamily people lately, and most of them are they're either IT software guys or developers or they're engineers, right? Yep. And so you're like the exception to the rule. You're like more like I am too. So that's what I like. I can relate to you.
See, so. and that's why I take the approach I take. Not only to be different, but I am different. I might be in somebody that I'm not. But you're right. When I'm coaching and mentoring these people, it is the engineer brain that comes to me most of the time because they understand spreadsheets. It's very rational for them. Not all of them, but a lot of them struggle with the softer side of this, right? With the soft arts, right? They don't understand empathy always. They don't understand that not everything is spreadsheetable in an ROI equation, right? There's certain things you're going to do to build brand for your apartment complex or for your management company or your construction company that you can't immediately see a bottom dollar result. And that's some of the things that they struggle with. But engineers, by and large, have done very, very well in this industry.
Yeah, they seem to do. That's just kind of what everybody I know.
Like our buddy Andrew. Andrew is kind of, I think he's like a physical chemist or something. I was like, God damn, you're smart, but he does great in this industry.
Yeah, he's but he's not like very I would say he's not very outgoing. He's right, because he's more of a totally introverted, right? Like ideally, you're both an intro and outrovert, because you got to get out in front of people. But he does a great job, right? He's one of the smartest guys out there for sure.
Oh yeah.
But yeah, he's more of an engineering type. But it's interesting, just the different characters that get into real estate, and now with social media, everybody's in real estate, right? Everybody's so.
Oh my God. And honestly, that's why I wrote the book. It really is. I was tired of seeing people get swallowed up get sucked into the emotion and the fervor at these events. People up on stage saying, "Hey, I joined this group and yesterday I was worth $43 trillion. They made it happen before I even joined. This is great." It's all rainbows, lollipops, and unicorns. I'm like, but it's not. So a lot of people would join, and after they join, they get the wake up call like, "Oh, dude, this is hard as shit. This is more than what I saw on stage. I only heard the success stories on stage. Dude, I've had people die on my properties. I've had arson on my properties, carjackings, home invasions. I've been sued multiple times. We've had Homeland Security take $5 million of my money and not tell me. I want people to hear this stuff. I love what I do. I don't want to do anything else, but it is really hard. It is really stressful. And there's a shit ton of liability that they're not hearing from the stage. That's why I wanted the book to scream the word bitch with an asterisk, because Amazon won't let me put the word bitch on the cover and let me sell the book there. But I just wanted people to know the real story. That's all.
That's awesome. And I'll tell you what, we've already gone towards our 45-minute mark. There's a lot more questions, but what I'd like to do is I'd like to get your book on Audible, listen to it, and then do another interview in the next,
of course,
month or two, and then we could dive into like analyzing properties and kind of going in depth on, some more stuff, because literally we could sit here and talk all day. Maybe next time I'll get a bourbon too. And
yeah, dude, I'm open to this anytime. I love talking about this with nothing in return expected. And if you've got a way to funnel some of those questions to me, dude, I'm more than happy to answer any of the questions people have.
That's awesome. We really appreciate it. And any kind of parting words? I mean, what's your kind of 5-year vision of where you're going to be in 5 years, and like where do you want to see your companies go to, and what's kind of your plan 5 years from now?
So 5 years from now, big picture, right? I always ask people, what are your big, ballsy, hairy, audacious goals that everybody thinks you're a moron for even contemplating? I want to own a G6, which is a Gulfstream, their largest plane, a G650. I want to own a baseball team. And I want to start, I'm going to cry suddenly, sorry. I want to start a nonprofit apartment complex for adults with learning disabilities, because we have an adult daughter with autism, and we want to create a safe place for those folks to call home, and a place where they feel safe, not bullied, because adults even bully people still to this day, which is disgusting. But it'll be offered on a sliding affordability scale. If you have an adult child with autism or Down syndrome or something like this, and you work at 7-Eleven or you work at McDonald's, we still want you to be able to have your kids there. So those people might not pay anything. Somebody that makes a couple $100,000 a year, yeah, you're going to pay full market rent. So that's the stuff that we're working toward. Big goals, but how do I get there? I don't know, but it'll happen.
So part of what I do is I do business development for a direct HUD lender, and just to throw this out there, that they have you could start this nonprofit, and essentially you can get up to 90% financing fixed for 35 years on a HUD loan. Wow. And you can use bonds, tax credits, and stuff. I mean, we could literally, with no money out of pocket, put that together with HUD. If you connect with the housing authority, you could easily do that. And there's no net worth, no liquidity requirements. You've got the experience as the operator. So you should really look at HUD. And I often, when I'm talking to people, because a lot of people don't look at HUD because it takes longer to close and different things. Yep. But if you're holding a property and you plan on holding it long term and it doesn't need much capex, it's a 35-year fixed rate at 2.69%, right? So
Wow.
85% leverage. And if you have an affordability component, yeah. So a lot of syndicators don't look at HUD. I started trying to reach out. I was fortunate enough to meet a gentleman who runs he's a direct lender, and he's teaching me the business, but it doesn't work for everything. But they also do construction, and they also work with a lot of like nonprofits. So properties can be market rate, or they can be affordable housing. So that you should look at that and get in line with a housing authority. And I have somebody in my office that does that. So you could actually probably start that sooner than you thought, right? And you can get bonds and tax credits and LIHTC, and you could probably stack that where you don't even need much money to get that thing rolling at all.
And you guys could help, or somebody that could help kind of navigate those waters?
Yes, I could help you for sure.
Oh, dude, that's awesome.
Yeah.
We've been overwhelmed because it's just the fear of the unknown. Like when I started at apartment complexes, I didn't know what I was doing. It was overwhelming. That's overwhelming. And, trying to think, how do we even go about, structuring a nonprofit? How do we raise money and have fundraisers and all that stuff? It's completely overwhelming, but at least this would be one thing off our plate. So yeah, I'll talk to my wife because she'll probably be the spearhead for it. But yeah, I definitely am interested in talking to you.
Yeah, I mean, I think that would be a perfect fit for you. I mean, long-term financing. It's funny. I was talking to somebody, and their model is they have a fund, and they don't do syndications. They just set it up as a fund, and then they only lever the properties like 60% loan to value, and they come in with the down payment and the capex out of the fund money. But when I was talking to him, he then tells me he has this property, which they're working on getting approved plans to build 50 units in California. And I go, do you know that HUD offers a construction loan up to 90% loan to cost, and it's a 40-year term. Yeah. It's actually a 42-year term. So for the right things, it makes sense sometimes. But going back to the nonprofit, this is where that would really excel. So glad you brought that up, and I'm glad that you came on the show. I had a lot of fun with you, and I'm going to listen to your book, and I'm going to schedule another one of these, and then we'll go in depth, and maybe we can show some pictures and do a little presentation so we could show kind of things you've done, little Bruce tricks like changing names and putting facades on the properties, sizzle features that would help us as we start acquiring properties, and also different tips like that. What is okay? Jerry says to Bruce, you need to speak with the regional center as well as the Department of Rehab. I'm an educational psych person and can help. Oh wow, great.
See, this is why I talk about it, because eventually somebody will go, hey, I know a person, or I can help directly. So fantastic. Where is it? It's live, I know, but where is this broadcasting? Is this Facebook Live, or what is this?
Yeah, so I have it streaming live to a few places, but it goes into my Facebook group. Okay. I should invite you in there. We've got 11,000 people in there, but a lot of people, they don't tune in, but they'll see it because it sits in there. They'll see it, reruns. And then I edit this. I have a virtual assistant in the Philippines, and she edits them and puts them on a podcast for me. And I have a podcast called Investor Financing Podcast, and then it goes there too. So over time, it gets listened to and heard many, many, many times. So people might be not listening live right now, but they will be eventually listening.
So if I can, get to the recording of this, will that little blurb pop up where the lady said that she could help? Maybe
Yeah, I know Jerry, so I could definitely connect you.
Oh yeah, dude, that would be amazing.
Yeah. So there we go.
Last word from me, then. I'll give you my email. So if anybody had questions that didn't get answered, please just send me a straight email if you want. It's bruce@apartmentguy.com. It's apt-guy.com. I'm glad to answer any questions anybody has.
Thank you so much. And I'm putting back up here on the screen the website, Bruce's website, and it's a link to his book if you want his book, or you can go read more about him and find some resources there. And you could probably contact him through there as well. Other than that, Bruce, thank you so much. And we will see you on the next show, and really appreciate your time.
Thanks for listening to the Investor Financing Podcast. For show notes and useful resources, please visit investorfinancingpodcast.com. For questions or comments, email info@investorfinancingpodcast.com. If you enjoy our show, please share it with your network. Until next time.